Here in this video, we're going to get into all of your Tesla stock news you need to know for this Sunday, and we also have like 10 or 15 different charts charting out where we are in the markets and what is likely to happen next. Let me tell you right now, a lot of these charts are pretty dang bullish. I'm not exactly the most bullish individual on the broader indexes. I could be wrong. I want to bring you the bullish take for this week and over the next couple of weeks. We also have some massive catalysts coming out this week, including the Fed, a lot of earnings, and really important economic data. So the work is cut out for us here in this video. This is your one-stop shop for everything you need to know and want to know every single day with Tesla, as well as the broader markets. Hit that subscribe button as well. If this is your first time to the channel and the YouTube algorithm has finally blessed you, consider sticking around a while. Let's go ahead and start with Oppenheimer's opinion on where our markets are going next. I did share this on my X account, Michael Tyler. Go ahead and give it a follow. I share a lot of interesting charts. I share a lot of different opinions over there, and as well as your Tesla stock news. So if you guys want to be informed on Tesla and the broader markets, well, go ahead and follow that account. They say, quote, "The S&P 500 could soar another 18% by year end, according to Oppenheimer. That's because the economy is strong and the Fed is likely to end its rate hike cycle. While 5% Treasury yields have sparked concern among investors, that's normal compared to previous eras. The S&P 500 is due for a monster rally by the end of the year as the Federal Reserve looks poised to dial back its war on inflation, according to Oppenheimer's chief investment strategist, John Stoltzfus. At the time of recording this video, futures for the NASDAQ are up 0.43%, S&P futures up 0.27%, and the Dow is up 0.13%. It looks like you're probably going to start Monday on a green note. I have also been in the camp that the markets are probably going to bounce here or at least trade sideways for a period of time. I actually went as far as saying in like 2 or 3 videos ago that getting out of short-term hedges in the markets probably makes sense. If you have contracts that expire anytime in November, those probably are not going to be the best hedges. If we get a bounce from here, those contracts are going to get destroyed. That's exactly what I did, is close out like 90%, 80% of the hedges that I have on the markets. The only hedge that I still have is on Apple, and that's for Apple earnings, because Apple, I think, could be a rough earnings. The reason why markets are almost certainly going to bounce, at least what historical trends have showed us. Obviously, I'm not a financial advisor. The markets might not bounce. It's the RSI. If you look at the relative strength index, the S&P SPY index or ETF is at 29.22. Anytime you have hit 30, you have seen a bounce pretty, soon. In between like a week or so. You usually don't stay at 30 on the RSI for all too long. Even during the Rona crash, you went way lower. I mean, you went to like 20 on the RSI, but you bounced right back up. More notably, back here in, January of 2022, the RSI hit about 24 and bounced right back up. And then basically every time since then, all throughout 2022, anytime the RSI hit 30, I don't care how bearish you are, you need to be buying stocks. And I don't think this time is necessarily going to be different. Interesting thing about where we are today is back during the Rona crash, there was obviously different things going on during the time. Back in 2022, the market dynamics were a lot different. Right now, the index, well, it's only done so well because of your big tech stocks. That is it. Your other names are down dramatically, but not your big tech. Your big tech has held the indexes higher. Now, as we head into 2024, and as big tech have had disappointing earnings and have been getting sold off, well, it makes sense to move that capital out of big tech into some of your small mid-cap stocks, your interest rate sensitive stocks if the Fed is done hiking and the next move is cutting. That's because big tech it's really not affected or hurt from the Fed raising rates. Again, I've used this analogy before in other videos, so we're not going to stick on it too long. But the Fed raising rates or lowering rates does not affect how many people buy iPhones or affect how many people sign up for Microsoft cloud services. Whereas your small mid-cap stocks that need to refinance debt, they need to issue debt, they are higher growing companies, they're not going to be profitable for a couple of years down the line. Those are the companies that are really affected. Think of something like a Tesla. It's the safety aspect. They don't need to raise capital. They don't need to dilute shareholders, but their business is highly affected on the course of Fed policy. That's why Tesla is still down 50% from all-time highs. And Apple, Microsoft, these other names made new 52-week highs in 2023. Point in being, the markets are forward-looking, so the markets are going to say, hey, who's going to benefit from the Fed lowering rates in 2024? It's not big tech, and big tech controls the weighting of the broader indexes. So if we do get more downside from here, it could really be a two-sided market where some of this market starts to do well. You're beating down stocks, especially those companies that do well on earnings, and some of your big tech names might do pretty pitifully. That's a possibility. That's where I think we'd get downside. I don't think it's going to be a Rona or 2022 style crash where everything gets obliterated. That's not what I'm saying. Tesla could do fine, could do well. Small mid-cap stocks could do well. I find it very hard to believe the markets rise from here, hit new all-time highs with the same leadership that got us to where we were in 2023. But again, I am not a financial advisor, but I have been in the markets for many, many years, and I can tell when the sentiment is flipping and what makes a logical sense. I can't tell you when it happens. I can't tell you if that change of capital will flow from big tech to small caps or big tech into more Tesla. If it's going to happen this week, if it's going to happen 3 months from now or 6 months from now, or when the Fed actually does cut rates. I don't know, but I do know it will happen at some point. So you want to be first to the punch before Wall Street actually catches on. And that's where we are right now. If you guys have not seen the last video that I put out, you definitely want to watch that one. We go in depth of why specifically Tesla is really a tale of two stories here. It's a big tech stock. It's going to be dragged down by a weakening broader index if that does actually happen. But the markets are going to realize at some point Tesla is probably the biggest beneficiary of the Fed lowering rates. Let's move on to the next chart that we have. And this is a chart of, obviously on top is the NASDAQ 100 index, the QQQ. And the red line is the percent of stocks in that NASDAQ 100 that are above their 100-day moving average. You're sitting at less than 20%. And you can see you're way, way down here. You're close to your October lows where you were at back in October. But yet the index is still way up here. And again, that highlights the concentration of capital in our markets. This next chart that we have is the S&P 500 returns after closing in a correction, which is over 10% down, less than 20% down. And on average, 1 week later, you rise about 1.5%. 2 weeks later, you're down about 1.5%. 3 weeks later, you're down about 2%. 1 month later, you're down about 2%. And 3 months later, you start to actually come back. You're a little bit green. 6 months later, on average, you're up 3.1%. And 1 year later, you are up 10.1%. And 80% of the time, you are in the green. So normally, corrections lead to buying opportunities. And I think that is where we are yet again. I just think where you should be buying is a little more specific. This is another fascinating chart, which doesn't mean all too much, but this is going to be the first time in maybe a long time since 1987 before Black Monday that you have actually seen gold outperform the S&P 500. At least if we don't get a bounce and gold continues to do well, yeah, that doesn't exactly look great. But don't draw any conclusions from this chart. This is another interesting chart from Bloomberg showing you are now at a record high for the amount of workers ever on strike at a single time at 48,100. Obviously, Stellantis has made a deal with the UAW. It looks like Ford as well. So you're probably going to get a lot less workers on strike here shortly. We'll see what kind of effect this does have on spending. A lot of people have been talking about really getting caught up on those credit card bills since they have been on strike pay. The King of Charts says the stock market crash is over. And this is basically just charting out from the October lows, this ascending channel, and you're basically hitting that downtrending trend line right now, connecting the October low. This is something we have on our charts as well. Based on his charts and also connecting the bearish downtrending chart, if you do start to actually find support and bounce here, you could do something like this heading into 2024 at some point, break out to new highs, and he does think that channel expanding will be due to the Fed pause. Now, we've already seen the Fed pause, but the Fed's been very much back and forth on their language, their jawboning, how they try to manipulate markets' expectations. Sometimes they sound more dovish. Sometimes they sound like they need to raise rates again. We're going to get a lot more clarity coming on Wednesday when we hear from Fed Jerome Powell. This is another good chart. There's been 34 declines over 72 years, once every 2+ years. Out of 34 declines, 12 turned into bear markets, so you have roughly a 35% chance of that happening. 22 corrections over 72 years. They occur every 3.27 years on average. 12 bear markets in 72 years. Bear markets occur every 6 years on average. The average correction days to bottom is 96 days. The average days to recovery is 109 days, and the average decline is 16%. And look at that. In case you did not know, the U.S. national debt is growing faster than the economy, and the red line is debt, and the blue line is the economy. Usually that's not great. And especially right now, it's not great since the servicing cost of this debt goes higher and higher every time the Fed raises rates. This is even one thing that could put pressure on the Fed to actually lower rates. That servicing cost is starting to be pretty expensive. I'm pretty sure we have pointed this chart out here on the channel. This is of the Russell 2000. You are at a historical level of bearishness for your small cap stocks. You haven't been this bearish since the global financial crisis and the internet bubble. This is charting the days since a last 52-week high, and the Russell 2000 just cannot do much of anything lately. It's been one of the worst performing assets by far of 2022 and 2023. And currently, you're at about 500 days since the last 52-week high. The short bear says this market is liquidity driven. And this is a more so scary chart for a lot of people. This is the NASDAQ from 1998 through 2004. That's the gray line here, overlaid with ARK Innovation ETF from 2016 until the present day, and they follow pretty well. So if this were to actually hold true, that would mean at some point in 2024, not quite midway through the year, probably around April if I were to speculate, that's where you could see the bottom and then recover from there. Honestly, that wouldn't be too far-fetched if we don't get some kind of Fed U-turn or something good that actually happens. Maybe we do get a more hawkish, aggressive Fed, and maybe there's no signs of rate cuts anywhere. Who knows? We can only speculate. If that were the case, then the markets, they're not going to look out a year or 2 years for rate cuts. 6 months or so, 3 months or so, that's what the markets are kind of expecting right now for rate cuts. That is near term enough for the markets to price that in. But just like you've seen in 2022, when it looks like it's years away from the Fed cutting rates, the markets are not going to price that in. The markets are not going to like that. This is also another chart for the bears. This is showing you speculative kind of trading. And what you can really point out of this, if you look at the red, is normally once you're like at the lows, right, at the bottom of the markets. Usually you peak as far as speculation in trades. A lot of this is hedging and going short. If you look down here, September was right here. You started to decline following that. As you know, in 2022, the low was, I believe, October 13th, in between October 13th, October 16th, and you were trending downwards at that time from an elevated level. He said, Jason Shapiro is saying this is really bad news right now because you have been declining on your speculative trades, your speculative positioning. A lot of this, again, is short positioning, and it just gets lower and lower, meaning that there's not really a lot of people that are fearful here, that are trying to protect against that downside. That could mean more pain to come. And basically, if I didn't summarize that good enough, comment under this post says, yeah, I noticed that specs got longer, the S&P. And he says, effing scary. If you're getting longer on the S&P during a time in which the markets are falling, that's usually a sign that you're not done falling yet. You have also seen this news recently that car payment defaults just hit a new 29-year high as borrowing costs surge. This is very interesting because we have precedents on this. Back in 08-09, you had 9-10% unemployment rates. Some states were much higher than that. That was the median average in the U.S. at the peak, right? About 9.5%. And you are seeing more car defaults today than when literally almost 10% of the U.S. was unemployed. That is ridiculous. So you really have two different stories going on right now. Because last week's GDP report came in at almost 5%. Durable goods orders came in at 4.7%. You were basically flat last month on durable goods orders. GDP went up over 2%, 2.9% from Q2. Yet, people are just not feeling wealthy. People are feeling like they're in the worst financial positions they've been in for some people, their entire lives. Yet the data is telling us something very different. The next GDP report is something, again, I also highlighted in one of the last videos. Currently, the expectation is 0.8%. On the low end, some people are expecting about 0.8% negative. So there is a decent chance that Q4 could actually be negative. And then if Q1 2024 is negative, then you have a problem. And this just means to me, the Fed will U-turn a lot faster than people are thinking. And that would be bullish for stocks. As long as we didn't go through a huge recession, that is bullish. Because after all, not being political here, but if you go into a recession during an election year, good luck remaining in office. And that's the last thing any president would want to do, is just hand over a free election when you could just cut rates a few times and spur some spending when you've basically already conquered inflation, besides housing, in which you have a longer term problem with housing. There's just not a lot of houses that are being built. I mean, this is a chart of the United States population. Back in 1959, there was about 176 million people that lived in the U.S. And this blue line, which you literally can't even see, it's at the bottom, is the amount of housing units that are being brought to market every single year. If we go ahead and eliminate the population, you can see that you're trading, or not trading, but you're building, way less houses than basically you've ever built before. You're at pretty much recessionary levels of home building, right? It's just not great. You're building like 1,000, 1,300 homes every month, like 1 million a year. It's not good. Yeah, to be more specific, in 2021, you built 1.6 million homes. In 2022, you built 1.5 million homes. Back in 1972, you built 2.36 million homes. I mean, in the 60s, you were building more homes than we are today. You're not going to conquer housing inflation. So I think this is something that you shouldn't hold your hat on too much. The fact that inflation is really just housing at this point. If you take out housing and homeowners equivalent rents, what people think they can rent their house out for, it's basically a survey that's flawed anyways. You really don't have any inflation today. So in other words, when that data starts to flip, and once you start to see the payroll reports coming in negative or close to negative, the Fed is very quickly going to U-turn. Again, it's an election year. Your highly politicized Fed, well, it's not going to not listen to what they're told. And you want to position for this now. You're heading into 2024. It's right around the corner. Wall Street is going to start positioning for this upside, more liquidity coming to our markets anytime now. And I literally made a whole video on this. It was the last video. The markets trade off of liquidity. Ever since the 90s, when the Fed started buying assets, when the Fed started bailing out the markets, it's all about the Fed. Don't fight the Fed. It's because really they should say don't fight liquidity. If there's no liquidity, stocks are not going to do well. If you take a look at the flows, I mean, this year you've seen $2.36 billion worth of flows, and the NASDAQ is up 27%. You've only seen flows into the big tech stocks. The rest of the markets have been getting drained. Whereas if you look at 2021, no surprise everything did well. You had $60.5 billion worth of money flow into the SPY and the QQQ. Only just those two. That's it. Not your other individual stocks. Just into these ETFs. To give you a little bit of context. So imagine what the flows look like on other stocks. And we have another chart for you. This is a chart showing the implied moves of some of the most anticipated earnings for this week. You can see some of the low guys down here would be a McDonald's, a BP, a Pfizer, a Caterpillar, Amgen, Eli Lilly. Apple is even down here at about 5%, which is historically pretty in line with what you normally see for implied volatility with Apple, but kind of on the low side. Sometimes it does reach that, 6-7% during times of volatility. On the higher end, Palantir, a fan favorite for sure, is up here at 13%. Shopify around 12%. DoorDash around 11%. PayPal 10+% up or down. Airbnb at about 9%. Starbucks also at about 8%. So we're going to get a lot of earnings this week, and we are expecting some of these guys to move pretty big. Also see from this chart from Earnings Whisper, you have last week was a big week as far as sectors, but this week is going to be the largest one, whether it is the banking ETF, whether it's technology, XLE, XLU, XLB, all kinds of different sectors. This is really the last big week of earnings season. After this week, earnings season's basically going to be concluded. There will still be other earnings, but they're not going to drive the markets higher or lower. And here is your lineup of earnings this week. I'll just point out the ones that are going to move the markets. It's simple. AMD Tuesday and after hours. Some of these guys could also move the markets, Supermicro and Qualcomm, just because they will affect NVIDIA, and NVIDIA does move our markets. Those two Wednesday and after hours, and then Apple Thursday and after hours. That's going to be the big one that could really send our markets much lower or even much higher. Apple's 11% of the QQQ. If Apple were to fall 10% like Google did, you're going to fall over 1% on the QQQ based on that alone, let alone any other sympathy moves from any other stocks. And your other biggest events this week is obviously going to be the Fed at 2 p.m. on Wednesday. You're going to get that interest rate decision, and then the FOMC press conference at 2:30. Currently, the markets are expecting a 98% chance of a continued pause, a 2% chance of a rate cut. I find this interesting because it's the first time that markets are pricing in even a remote chance of getting a rate cut. It's not going to happen. That would be unprecedented if the Fed did cut rates when only 2% of investors were expecting that. But hey, you never know. We've seen some crazy things over the last couple of years. Another big event is going to be on Monday at 8 p.m. Apple has never held an event at 8 p.m. before, like almost nighttime. So it's going to be a little bit different. Who knows what's going to actually be said? Some people think a new MacBook's going to be announced. We really have no idea. So that one could be important. Normally, Apple sells off basically after any event they hold. So that could also have an impact on our markets. Let's now get into a couple different things on Tesla stock you also should know heading into this new trading week. The UAW has just expanded its strike against General Motors to include plants in Spring Hill, Tennessee. This is GM's largest manufacturing facility in North America. It looks clear Stellantis and Ford have accepted their fate as a secondary car maker, really not competing for a mass market share of EVs. GM, it looks like they want to hold out for a better deal, maybe to actually be able to compete with someone like a Tesla. Ford and Stellantis, they just capitulated. There will be no competition on a mass market perspective for Tesla. At least from these two guys. And GM is probably going to fold as well. Tesla Chan is reporting that the Model X all-wheel drive Plaid estimated delivery period has been extended. If you order now, you can receive delivery from December of 2023 to January of 2024. This is usually a good sign that they're seeing good demand for this vehicle. And I've actually been seeing quite a bit more Model X's in my state of Michigan, which I don't see many Teslas. You do see them, but Model X has been surprisingly pretty popular lately. I think I've seen more of those than I have Model 3s or Model Ys. A Cybertruck was spotted with snow on the ground in Idaho just over this weekend using a Tesla supercharger. South Carolina residents are calling on the state to lift a direct auto sales ban. They basically say it's almost impossible to buy or lease a Tesla in their state because of the restraint of trade that infringes on their freedom of choice as customers. This is because most states in the US do not allow direct sales from a Tesla to customers. The way Tesla's got around this is by putting their dealerships, if you will, their service centers on most of the time tribal grounds, which don't follow those same laws as the state would. So if you don't have a lot of tribal grounds near you, well, you're probably not going to have a Tesla servicing station near you as well. Lucid Motors is teasing the Lucid Gravity, and they say see you in LA, and it has the infamous bear. It's kind of like Easter eggs with the Lucid. They place these bears in different small locations throughout the vehicle, and it looks like this one's actually on the wheel, the hubcap, if I were to speculate here. At least that's what it looks like. And it looks like Tesla's now added a charging calculator on their website, and it says how much you can save with the wall connector, and daily for 69 miles driven, the average cost would be about $3, and your gas savings would be essentially like $7.67 if you were actually paying for gas. California Governor Gavin Newsom test drives the new Tesla Model 3. He actually visited the Shanghai plant in China, and he says, quote, "The working model of Tesla Gigafactory Shanghai has benefited both China and the United States." Newsom test drove the new Model 3. He said he is optimistic about the future of self-driving cars, saying that Tesla's R&D headquarters in California focuses on autonomous driving and artificial intelligence. He stressed that autonomous driving is the future. I don't know how much good news that is, but it's better than not, considering California, as far as GDP, is larger than like 98% of other countries. I believe California is like the 6th largest country in the world, if California was its own country, as far as GDP. And I was actually pretty dang close on that. California itself has a larger GDP than France, India, Italy, and Brazil, it would rank as number 6th in the world if it were its own separate country. So I think this is good. Gavin Newsom had good things to say about autonomous driving. Last but not least, we're not going to have a lot of economic data this week. It's going to be a pretty dry week besides that Apple event on Monday until we get to Wednesday and hear from the Fed. There's smaller data points here and there, Dallas Fed Services, Philly Fed Services, that can move the markets, but the markets are really going to be paying attention to this Apple event on Monday, the Fed, Apple earnings on Thursday, and this economic data on Friday. It's the non-farm payrolls. You're expecting 188,000. I think if this comes in way lower than expectations, which is not really what we're used to, that would be really good for the markets. The markets are going to say, hey, maybe the economy is weakening a lot faster than we thought. Maybe that does mean we do get rate cuts faster than we thought. So be on the lookout for that data report coming Friday at 8:30 in the morning, as well as the unemployment rate. That is at 3.8%. If that does go higher, that's not, that's in the grand scope of things, that's not going to be good, but it might be good for the markets. That was the same as last month. You're expecting 3.8%. I believe it's been that way for the last 2 months, so this would be the third month that you have stayed at 3.8% for the unemployment rate. And finally, last but not least, if you guys did not see the videos over this weekend, the option activity is implying that we will see a big move this week. The 220 call had 49,000 for volume on Friday, and the 200 put had 33,000 for volume on Friday. By far the most active two strikes, and they're both at pretty critical levels. 220 is an important level on the upside. 200 is an important level on the downside. So markets are expecting quite the move from Tesla this week. So that is going to do it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with us live in real time, I send out all of the alerts on trades that I make. I provide a thesis on why I'm making them. Link down below in the description of this video. We will have a course coming out on trading as well, just to teach you how to trade, that will be sent out for free to anyone that is a part of that community, just so everyone in that community is well-rounded, has a good knowledge of trading and how to trade, just all different kind of strategies from A to Z. That information will be in there. So if you guys want to get that for free, link down below in the description of this video. Sign up for the trading community. Nonetheless, that is going to do it. Enjoy the rest of your day and night, and I will see you in the next one.